What differentiates the returns of these three modeled portfolios? An analysis by iCapital Marketplace compared the historical performance of three distinct portfolios. A traditional 60-40 equities and bonds portfolio, adding 20% of alternatives to the mix, and a portfolio only of alternatives. The traditional 60-40 portfolio has historically served as a balanced mix with equities and bonds acting as hedges against each other. However, recent trends show that this hedge is weakening. The fixed income component of the 60-40 portfolio, which typically offered stability, has become a contributing factor to overall volatility. In recent periods, this component contributed 15% of the portfolio's volatility compared to just 5% historically. The traditional 60-40 portfolio has underperformed, especially in weaker market conditions. In the current environment of high inflation, rising interest rates, and geopolitical uncertainties, the portfolio's returns have struggled. The analysis used 10,000 Monte Carlo simulations to test various market scenarios. The results showed that in 98.6% of these scenarios, the portfolio with a 20% allocation to alternatives outperformed the traditional 60-40 mix, and the full alternative significantly outperformed. A traditional 60-40 portfolio would have returned $2,191,000 on $1 million invested over the past 16 years. With a $1 million investment, adding 20% in alternatives with 8% private equity, 8% private credit, 2% real estate, and 2% hedge funds would have resulted in a $320,000 higher return. This adjustment not only increased annual revenues by nearly 1%, translating to a 15% boost during that period, but also reduced losses during downturns. On its own, a portfolio fully allocated to alternatives would have grown that $1 million into $4.1 million, almost double the returns of the traditional mix. Alternative assets have demonstrated remarkable resilience during market stress. They captured only 22% of the declines of a traditional stock and bond portfolio during downturns, reducing drawdowns by approximately 17%. Moreover, the portfolio with a 20% alternatives allocation consistently achieved higher returns and lower volatility, improving the Sharpe ratio, a key measure of return relative to risk across all performance levels. This analysis highlights a growing trend amongst investors seeking stability and enhanced returns by incorporating alternative assets into their portfolio. Alternative assets are far more accessible today, and a broader selection of accessible investment options make them a mainstream component of well-balanced portfolios. Private market assets are now valued at over $13 trillion, and investing in these assets is more straightforward than ever. Explore how alternative assets can enhance your investment strategy and better balance your portfolio. To find out more, contact us at Blue Lakes.